if you notice, I know I keep going back to this webinar calendar here, just again to show you all the upcoming webinars. But if you notice, I've gone through, like I mentioned yesterday, and I put in a bunch of pre-recorded webinars as well that you can watch at any time. And a lot of those have been, they're a bit of a mix of binaries and spreads. And last week I put in a couple in particular, like this one here, common mistakes with Nadex, the Nadex spread traders make, understanding risk and reward with spreads. How many of you guys have been able to watch those two videos? Just a quick show of hands. Wow, Randall, awesome. 86 ticks today, power play rock. Great job, Randall. That is great, man. What were you trading on those 86 ticks? Mainly NQ or oil, or what were you trading? NQ, that is awesome, man. That is awesome. Okay, so Carl, you were able to watch these two. Anyone else able to watch these two webinars here about common mistakes or understanding risk and reward? Just trying to get an idea of how in depth to get with you guys today to make sure that we get a good understanding of spreads here. Okay, you have before. One other quick question. How many of you on here also trade Nadex binaries or have demo traded them or have some experience with binaries? But you're kind of just now getting into spreads, or you're wanting to understand how to trade spreads, but you don't have a lot of experience with spreads, but you do have some with binaries. Okay. All right, perfect. Okay, well, what I want to dig into is we want to cover a little bit of basics, and then I want to get into a few examples, and we'll look at, some live markets, some live spread and stuff like that. First of all, what I can tell you is you have to, if you're a binary trader and you're just now getting into spreads, the first thing you have to do is kind of, in a sense, forget everything you know about binaries and recognize that spreads work completely different, okay? Spreads are not, 0 or 100 at expiration, okay? Spreads are basically $1 a tick from where you get in to where you get out, all right? And I want to kind of address, if you're not familiar with the basics of spreads, you can go right here to Elite Education, go to Nadex Spreads, and right here go to Nadex 101 Courses, okay? And this will walk you through spreads, all right? The other thing you can do is go up here to Webinars and go to Nadex Spread Webinars. This is kind of a library of a bunch of different spread webinars that I've done, okay? Everywhere from right here, back to the basics. This is a basic, hey, let me hold your hand and walk you through it like a 5-year-old. You have no idea what a spread is. Let me start with the basics. Here's some common mistakes people make with, spreads, some successful trading tips, how to trade news, all kind of different information here. Picking the right spread, directional trading with spreads. If you really want to dig in and learn spreads, we've got a bunch of information there for you, okay? So today we want to talk about trading spreads with the ultimate power plays, all right? Because I did cover it in the training course, and we were very basic about it and told you, when it comes to trading spreads with the ultimate power play, what you want to do is to use the scanner. I don't know if all of you are using the scanner. Show of hands, how many of you on here trade spreads but don't use the scanner? Let me start with that. I only ask some of these questions so I know how much time to spend on certain things to make sure you guys get it, okay? If you're trading spreads, for example, and you come over here to the Nadex platform, right? Okay, let's just do a brief overview. And let's say I pick indices spreads, and I want to trade the US Tech 100, which is the NASDAQ, right? Well, right now I'm looking at this going, okay, I've got spreads that expire, started at 12, expire at 2. I've got spreads that expire at 3. I've got spreads that expire at 4:15, and I've got the dailies at 4:15. Okay, well, in the training course for power plays, John told me that to trade the, daily near the market, okay? Now, first of all, I want to make a clarification, okay? Either one of these are considered daily when I say that. The ones that say daily 4:15 or say 8 a.m. to 4:15. I've heard a couple of people say, oh, I can't find any spreads, and I'm looking right at them. And I realized that some of you guys were only looking at these spreads here and not at these as well. Okay, so when I say daily, I mean those ones that expire into the day. But let's say I'm trading spreads, so I come right here to daily 415, and I've got 4 different ones here. I've got some with a floor of 59.40 going up to 59.80. Then I've got 20 to 60. I've got 00 to 40. I've got these different ones, right? Okay, well, so I'm a newbie. I click on the first one. So I'm looking to buy, right? So I look on the first one here. I go, okay, if I want to buy this spread, I'm putting up $122 and can make $278. Okay, let me go to the next one. Let me open it. I want to buy. Okay, this one I got to put up $256. Okay, this next one I want to buy. Let me say, okay, now I got to put up $357. And this one, if I buy that one, I got to put up $476. Okay, well, I just like this one because I have to put up the least amount of money, right? That's what you do most of the time. Okay, but that's a big common mistake. Okay, if you make that mistake, if you do that, you need to immediately, when you get off of this webinar, go back here to these pre-recorded webinars and watch this webinar and this one, Understanding Risk and Reward. Because if you're picking a spread based on the cost of the spread, meaning if you're picking a spread because you do that and see how much you have to put up, you are going to not make money. Okay, what you have to pay attention to here, okay, well, let me get back to that. I'm jumping ahead. But do you see what I mean? You have to go through each one of these and open up a ticket, right? And click whether you want to buy or sell, how many you want, to see how much you have to put up and what your potential reward is, right? Then you got to go to the next one. How many of you have done that on the Nadex platform? Going through and seeing how much you got to put up. Right? Used to. And then when you got to go over to the 8 a.m. to 4:15s and click those and say, okay, well, shoot, now there's 5 of these, so let me click every single one of these and hit buy one. Okay, that one, $22. I like that. Okay, cool. How much is this one? Okay, $69. Okay, how much is this one? 149. Okay, let me open the next one. How much is that one? 226. Okay, so what's better for me? Well, crap, I already forgot what it said on these over here, right? How do you keep track of all that? You've got this trade setting up, you've had a cluster go off, you're looking at a potential trade, then you're sitting here on this platform going through all of these trades, trying to figure out which one is best, trying to remember what you clicked on and how much you had to put up for this spread or that spread. And by the time you figure out one you might possibly want, the trade's already gone. The trade's already moved halfway before you can figure it out, right? Or you just make some quick decision, you grab a random one or the cheapest one you can find. And then you wonder why you didn't make any money on it, right? And you're like, these spread things don't work. Okay, so that's the first thing I want to make sure that you understand with the scanner, okay, and the power of the scanner. So if we go to the scanner here, I just want to do a quick overview of a couple of things to show you why it's absolutely vital if you're going to be successful in trading spreads, okay? So let's just say that I want to trade the US Tech 100, what we just looked at, okay? I can unclick it or click it. I can click whatever market I want to trade. Now I want to trade US Tech 100. What did it just do for me right here? It pulled up every spread available on the US Tech 100. The 2 o'clocks, the 2 o'clock expirations, the 3 o'clock expirations, and both of those ones that expire at 4:15. All of those ones that expire 4:15. Remember that? Over here, they're broken down into 2 different sections. I had to go back and forth. They're right here in front of me. See that? And I clearly see the floors and the ceilings. I see what I can sell it for, what I can buy it for. Right? It's all in one easy place to see. Much, much easier and much quicker. Okay? Now, what is the other thing that we talked about having to do in here? All right, let me click this one On the buy side, if I get 1, okay, my max loss is 157, my max profit 243. Okay, over here, if I click 1, how much? I'm going through and trying to figure that out on all these different ones, right? What do you think this is over here on the buy side? Red, green, red, green. Each spread that expires at 415 is listed right here. Here's the floor and the ceiling. What do you think this means? $90 compared to $210. That means I've got to put up $91. That's the most I can, that's my max risk. The green plus 210 is the most I can make. What do you think it is on the sell side? It's all right there for you, where you can easily say, okay, I'm looking to buy. Here's the buy side. I can just scan this red and I see the numbers. I see exactly how much I've got to put up for each one of these spreads in an instant. I can click on that spread to buy it. I can open a ticket and buy it straight out of the scanner, or I can do an instant order out of the scanner. Boom, boom, boom. So first of all, do you see just that alone right there? That quick and easy, simple. How much simpler that makes trading Nadex spreads. For one, being able just to find them quickly, all on one page. For two, you don't have to open up tickets to figure out how much you've got to put up. It's all right there, so much simpler. And then you can even click right on it, once you integrate your Nadex platform, and you enter and exit your orders all right here from the scanner. Okay? So that is just, that alone makes trading Nadex spreads a million times different, because you can see it quickly. Okay? So that is the first mistake that the spread traders make, is not using the scanner. All right? Now, for some of you guys, this may be super elementary, but I'm going to cover some of this elementary stuff. Then we'll get into a little bit of advanced stuff. All right? So back here, let's go back to some of the basic mistakes. Okay? Many of you that do not fully understand how spreads work. Like I said, you'll go through here and you'll open one, and you'll say, okay, I want to buy. Okay, I got to put up $22 for that spread. Cool. All right, the next one, I got to put up, $70 on that spread. Okay, this one, I got to put up, $151. This one, I got to put $220. Okay, forget it. I like this one. I only have to put up $22 on that one. I'm taking it. Okay, for one, you already missed the trade. But for two, what is the biggest reason that you went back and chose that particular spread over the others? Because all you were looking at was this number right here of how much money you had to put up. Okay? We've all done that. Every single one of you that's traded spreads has done that at some point. You went with the lowest possible cost of a spread, right? The lowest possible amount you had to put up with a spread. Raise your hand if you've done it, and any of you that aren't raising your hand are lying, and you know it, right? We've all done it. Kevin said, yep, I've done it, and it rarely worked. Absolutely, okay? So I want you to switch your mindset for a moment, okay? In one sense, I'm going to tell you, forget everything you know about binaries, because they work completely different, and they do. But there are certain concepts that are the same, and I think some of you understand this better on the binary side. So if I can help shape your mind and switch it over to the spread side, it might be a couple of aha moments for you. Let's go look at some binaries. On the same market, US Tech 100, let's look at 3 o'clock. I think the market's going up, so I want to buy a binary. Well, if I click this binary right here and I say I want to buy it, I got to put up $85. What about this one up here? I only got to put up $5. I like that one. I'm going to buy that one. Well, hey, I bought it and the market went up. How come I didn't make $100? How come I didn't win $100? Do we all understand that a lot easier on binaries going, well, duh, you bought it way out there. You bought that cheapy one way out there. It's not going to move as fast. The market has to move a lot. We've talked about this, right? We've talked about out of the money binaries, in the money binaries, at the money binaries, right? So does everybody understand why, Kevin just said a minute ago, yeah, I've done that. It rarely worked. Well, imagine if you're a binary trader and every time you were buying that $5 binary, do you think you'd also probably say, yeah, all the time, and it rarely worked? Well, why? Because where are you buying in? The indicative's at 59.50. You bought a strike at 59.72, 22 points above the market. That's where you bought in. That's why you're able to buy so cheap. And you wonder why you're not winning a whole lot, right? Does the market move 22 points? Sure. But that's 90 ticks. Is that going to happen a lot? Is that going to happen half the time, 90% of the time? Probably not. Okay. Does that make sense? Yeah, only to Lori, exactly. So you get that on the binary side, right? Why, when you go with these really low price ones, it's a very low probability because you're buying so far away, right? Okay. Now let's kind of go back to spreads. And let's talk about something that, here's the biggest misconception with spreads. Okay? Because what will happen here is you'll have your chart up, okay? And you're watching some trade and you say, oh, okay, for example, okay, there's a trade set up right now for me to go short, as an example. And the chart said 59.51.25, right? So when my chart said that, I came over here and I looked at spreads, and I went through here and I went through these couple different ones, and or let's say it was a set up to go long that we were going to buy. Okay, so I went here and I clicked this one, and okay, I can put up 27 bucks, and then this one, and I can put up oh crap, I accidentally ordered that one. And I can do this one, I can put up 85 bucks. All right, or this one down here, and I can do 241. I don't like that. Let me just get this one because it's $27, right? You've all done that. Then you're watching your chart, and you bought when the chart said 59.51.25. Okay, right here. 59.51.25. That's when you bought and you pressed enter on that spread. Okay. Well, and then what happens is you're right. The market goes up, right? And let's see here, 51, and the market goes up to, let's just say 56. Okay. 59.56. And you're thinking, okay, on my chart, it went up to 56. So that's technically 20 ticks on a Nadex spread, right? You're saying, okay, well, that's where it was when I pressed enter. This is where the chart is now. That's 20 ticks on a Nadex spread, correct? Everybody agree? So you just automatically think, well, it's $1 a tick, so I should have made $20 on my Nadex spread. But then you look at your Nadex spread and you're up about $3. How many of you have had that happen? And you say, these spreads don't work. This Nadex thing is a scam. These spreads don't work. Forget this. Right? How many times have you been there? You're like, okay, the market moved 20 ticks from where I pressed the button to where it is now. Why don't I have $20? I've only got like a couple. This is a scam. Well, here is your big mistake, okay? All you looked at when you checked these spreads was what? How much do I have to put up? How much do I have to put up? And then you wonder why you're not making money. It's no different than with binaries. Hey, all I'm looking at is how much do I have to put up? Oh, there we go. And you're not paying any attention to the strike. Is that smart? No, not at all. Look at the spreads. Let's look at these spreads. See these different spreads? All you were concerned with how much it would cost you to get in. Look at right here, though. Look at the different prices of the spread. 59.32, 42, 49, 56, 66. Oh, wait a minute. That means that's where you're buying into the spread. Does that make sense? Where did we buy into that cheapy spread? 59.66. 59.66. You bought way up here. Do you see that? That's where you bought into the spread. Just like, it's like saying this. It's like saying, well, okay, I bought this binary right here for $5. Okay? So I risked $5.75 and I could make $94.25 if the market goes up there. If the market went all the way up and expired above this strike, you could make $94.25, correct? Everybody agree? Yeah? Okay. So the market moved enough up there for me to make $94.25. So if the market moved up here to 59.73, let's say, and I made 94 bucks, well, I should be able to buy this one right here and the market go way up there, and I also make 93 bucks, correct? No, because it's a complete different binary. I bought in at a complete different place. Even if the market goes up to the same level, I don't make the same. If the market moved all the way up here, past this strike, would I make the same amount of money on any binary that I chose? No, it's going to be, I'm going to make on that binary based on where I bought into that binary, correct? Does that make sense? That's very elementary. Some of you are like, why am I wasting my time on here? But does that make sense? Okay, well, how is it any different with spreads? It's not. Look, where are you buying into the spread? Notice that from 32 to 66 is what? 34 points different? Right? 34 points. With Nadex, the way it ticks in point 10, there's what? There's 10 ticks per point, right? Yes? So that's 340 ticks difference on all these spreads of where you can buy in. So is it important to look at how much you got to put up to get in the spread? Or is it important to look at where am I getting in the spread? Because if I got in the spread 340 points behind or 150 points behind, and then the market moves 20 ticks, and I'm going, how come I didn't make $20? Duh, right? I mean, does that kind of make sense? Okay, so that is the biggest mistake that spread traders make, is not looking where they get into the spread, okay? And you have to realize that the way spreads work, where I get in, okay, for example, let's open this one back up. If I bought in at 5966.9, okay, at expiration, wherever the market expires at, I'm going to get $1 a tick based on where I bought in compared to where it expired. Or I'm going to lose $1 a tick based on where I got in compared to where it expired. That's going to be dollar per tick at expiration. Okay? Between now and expiration, I'm going to get $1 per tick based on where I got in compared to where I can get out. All right? So, if the market was right here when I bought, but the spread I bought was way up here. I bought into it right here. This is where I bought. Well, if the market goes up 20 ticks from where it was, do you think the value of my spread way up here will go up 20 ticks dollar for dollar? No. It will go up in value as the market goes up, but it's not going to go up $1 per tick because I bought in way up here. It might go up like 50 cents a tick or something, maybe even less, right? But it's not going to go up $1 per tick because I bought up here. Does that make sense? Any questions on that? That's called premium. There's premium built into these spreads, okay? When you have a spread that you can buy in so low to the floor and you have very little risk, who's taking all the risk there? Well, the market maker, right? So the market maker adds some premium in there, all right? It's again, like we talked about yesterday, about premium collection on binaries. When we say the word premium, what do we think of? What do we think of a premium that we pay every month? An insurance premium. A spread is insurance. A spread with a capped risk, a spread where you can get in close to the floor, is insurance. You can get in this trade, the most you can lose is $28. Okay? That's a very low risk trade. You're going to pay a little bit of a premium for that peace of mind. Right? Now, if the market takes off and shoots way, way up here, a big, huge move, even that spread you got into right here would make some good money, wouldn't it? But it requires what? A really big move, correct? Does that make sense? If you're going to get one of those real cheap spreads up here, it would require a big move up there for that spread to make some money. Right? Does that sound familiar for you binary traders? That if I'm going to buy one of these real cheap binaries up here, what does the market have to do? We talked about this on the webinar yesterday. The market has to move in your direction, has to move quite a bit up there in your direction, and has to move up there in that direction before the expiration. It's kind of the same concept. Does that make sense? Can any of you see now where you probably made some mistakes in the past with spreads because you weren't paying attention to where you got in? Okay? Over here on these daily 415s, it's the same thing. Okay? We've got 53, 47, 36. I mean, we've got 20 points difference between these two spreads. That's 200 ticks, $200 difference of where I'm buying in. Okay? So that is what is super important to pay attention to. So that spread I bought way up here isn't going to move $1 a tick as the market moves $1 a tick. It'll move some, right? But not $1 a tick. But now let's say I bought it right here at 59.66. okay? And the market expires at 59.70. So I bought it at 66. It did not move $1 a tick as I'm watching it live because of where I bought it. But at expiration, what would I get? I would get the difference from 59.66, right, up to 59.70, which is how much? 4 points times 10 ticks a point, 40 points, 40 ticks, so $40, right? Does that make sense? If I bought it here at 66, okay, if I bought it here at 66, can't get it to sit there. When the market was right here, I bought it at 66. As this market is moving up, it's going up in value, you know, because it's getting more valuable, right? I bought it. For me to get out of it, I have to sell it to somebody who's willing to buy it. So as the market's going up, the value of the spread is going up. It's getting more valuable to someone else, so I could sell out of it based on what they'll give me for it. But it's going up at a fraction of $1 a tick, right? But if it expired up here at 70, what do I get at expiration? I get the difference of where I bought in compared to where it expired. So that would be 4 points times 10 ticks per point. So I'd get $40. Does that make sense, right? Okay. What spread, though, if I was looking right here, all right? If the market was right here around 59.49, and I want to mirror the market, I want to mirror the underlying as close as possible. I want to get as close as possible as I can to trading like a futures trader would. You know, when we look at trading the power plays, I want to go tick for tick as close as I can, dollar for tick. Well, then where do I need to get a spread? As close to right where the market is as possible. Correct? Right near the market. Okay? And I need to kind of be towards the middle of a spread. Because if you're at the top, like the ceiling of a spread, it's not going to move very fast and you don't have a lot of room to profit, do you? So you want to be like near the middle of a spread. You want to have some room still to profit. So what does that mean? Why do you think I said in training that you want the daily near the market spreads if you want to mirror the underlying market as close as possible trading power plays? That's why. Because the closer you are to where the market currently is, the closer it's going to move $1 a tick as it moves. Does that all make sense? Does that clear anything up for anyone? Some of you might have all already knew this, but for those of you that are new, does that make sense why I taught it that way? Okay, so let's take a look here at the scanner again. So not only does the scanner show you the 2 o'clock expirations, the 3 o'clocks, and the 4:15s, and it shows you all the 4:15s right here. It shows you how much you can buy them for, how much you can sell them for. Then over here you see your risk and reward on the buy side, right? You see your risk and reward on the sell side. Much easier to see all this, right? Okay. Look at this spread right here that we've been talking about. See this one right here? The 59.40 to 59.80, right? That's the one we've been talking about. Or, no, I'm lying to you. It's this one. This one right here. This is the one we've been talking about. You only had to put up like 27 or 30 bucks, right? But where's the market at? 59.52. Where are you buying in at? 59.67. Way up there, right? Okay. So this is the 65 to 95. Which one is that? This one right here. See that? Notice this section right here, proximity and premium. Okay. Well, when we talk about, hey, the market's right here, but that spread I can buy is way up here. What that is where is the spread you're buying? Where is your buy-in price in relation to the current market? What proximity is it away? How far away is it? Is it in the close proximity of right near it, or is it a much further away proximity? That makes sense, right? Well, what is that column right there? Proximity. Plus 67. See that? What about the proximity of this one down here? Negative 72. This means you're buying in way below the market. You see that? You don't have to go and open those tickets and do the math. It's right there. So when I tell you, hey, if you want to trade power plays, do the end of the day, near the market, low proximity spreads. How do you, if you're over here on the Nadex platform, you're not only having to look at, the prices, but then you're having to go and, okay, so 59.51 compared to 58.1, that's how many points times how many ticks times how many dollars, how far away. Forget all that math. The trade's gone, right? No one got time for that. It's all right here. What is the proximity? So when I'm seeing a trade set up, what do I want to do? I pull up the scanner. I look at the 415s. I go right here. And what is my eye drawn to? The ones as close as possible, right? Proximity-wise. Not 64 way above the market, not 74 way below the market, but right here. Within 0 or 1 or 2. They're just a couple of ticks away. That makes sense? One of those are the one I want to go with. Okay? And then what can I do? Okay, either one of these spreads are really close by. Let me look over here. I can put up $512 to potentially make $288, or I can put up $161 to potentially make $139. I think I'm going to buy that one. Yeah? I mean, you could make more on this one if the market just shot off, but what's the likelihood that you're, hey, you're going to be pretty happy with getting 139, right? If the market takes off. So is that not a ton easier? Instead of going through all that back and forth math on the Nadex website, you pull it up, you go here, you scan it. Okay, it's clearly one of these two that I want. How much do I got to put up? Okay, I want that one. Click it and buy it. Done. Like, you're already in the trade by the time you've even gotten to the second one, doing the math over here, trying to figure out which one, right? Everybody get that? Does that make sense? Does it also make sense why, okay, if I'm choosing between one of these two, why I'd probably go with this one? Okay, I mean, I can put up $500 to make that, or put up 160 to make that. Okay, well, I'm gonna be fine with that. Also, for the price of putting up 510, I could get like 3 of these and be making $3 a tick up to 140 ticks, right? So it only makes sense to go with this one, right? Okay, so that is how the scanner, first of all, really simplifies spreads, where you don't get caught up in the going back and forth with math. You don't get caught up in, oh, I just bought the cheapest one and it's way up here and now I know I didn't make any money. I'm going with the closest one possible. All right? Now, sometimes based on the market movement or the implied volatility, that affects the prices of binaries. It affects the prices of spreads. It affects the premium and the proximity of spreads. And we all know that sometimes you can't find some that are right at 0 or 1, can you? How many of you have had that happen? Well, hey, that sounds great. You taught us to go low proximity, but sometimes they're not there, right? Sometimes they're like, oh man, they're just crazy big, okay, especially on NQ. Okay, well, first of all, the biggest issue there is some of you are only looking at these dailies, as opposed to a lot of times the best proximities end up being the 8 a.m. to 4:15s. So if you're using the Nadex platform and you're only looking at these dailies, you're missing out on the good ones where you can see them on the scanner. But even on the scanner, sometimes they'll be really high, won't they? Okay. Now, it does not mean that you cannot trade them if they're further away. Like if you've got one that's 11 or 14 or in the teens, you can still use those, all right? They will still move, but they're not going to quite move $1 a tick. They might only move, say, 70 cents a tick until expiration. Does that make sense? Okay, so you can go, I mean, you want as close as possible. And if you can only get something, in the teens, say, you can do that. They're not going to move quite as fast, but you can do it. Do you really want to get caught up in doing the, 30 and 40s? No, not really. Okay. In that case, you might want to just stay out of that trade. But there are a couple other options here. Okay. Because you've seen that. Sometimes they're not that close. You want them close. If you can get them in the teens, you can still trade them. Just know that you're not going to get quite as much. But don't get up into these 40s and 60 directionally. Okay? You can look at the shorter term ones. Or let's say there's nothing there on the dailies. But, it's 143 right now. We do have a 3 o'clock spread, and I can get it for, 2 or 4 or 6. Okay, these are going to move a little bit slower as well, okay, until expiration. But you can look at the shorter term as well. Chip says, would you filter out the larger proximity? You can do that. Yeah, I mean, you can do that to make it easy. If you know that you are only looking for, the dailies and you only want something right near the money, and it'll just show you the best ones. Okay, or you can filter out proximity where you don't want, you'll do any, but you don't want anything that's over 20, for example, just so you can narrow it down. Okay, and not get, confused by everything else. You can do that. Okay. So you can, if there's just absolutely nothing there that's real close proximity, you can go a little further out in the teens if you have to. You just got to be prepared. This is not going to quite move $1 a tick. If there's nothing really there, you can check the intradays and see, well, hey, this one is only a few ticks away. It might move a little slower because it's an intraday, but as it gets closer to expiration, but I can put up 54 bucks. I've still got 45 ticks of room between now and expiration, and it's real close. I'll grab that. Maybe I'll grab a few of those. You can still do that. Okay, so you can look at those, but what you want is to make sure, don't be blind and go, okay, I'm looking to buy, these are all, let's say these are all like in the 30s, and you're like, oh, well, look, here's an intraday that's at a 7. Okay, I can handle being 7 proximity away, right? That's not bad. Let me take that. Look over here. What's the most you can make? It's 20 bucks. And that might be fine. I'm not saying that's bad. But you have to look at, oh, look, this one's only 18. I can do 18. Really? You're right at the ceiling. Where's the market at? 49.49, right? There's no money. There's no money in there. Just the premium, $3. That makes sense? So, if you have to look at the shorter term ones and you see something that's close, look and see how much room is even left to profit in there. All right, because yeah, you still got your fees too. Okay, so look for super close, then look for these in the teens. Worst case, you can look at these other ones here, but make sure you see what your proximity is. Now, let's just say it's just a high IV day, okay? And there's just nothing in close proximity here. Like it's just in the 40s, 50s, 70s, and there's really not an option there. Well, what do? I just can't trade? I'm just going to miss this trade? Something I teach a lot of. When it comes to binaries and spreads, we normally recommend new traders start with spreads, right? Spreads are safer, they're not an all or nothing. Helps you learn the market, learn to try to emulate and mimic, the underlying market. But we, as you know, trade binaries and spreads. And I hear a lot of people say, oh, I'm a Nadex spread trader. Oh, I'm a binary trader. Well, I'm a Nadex trader. I'm not going to limit myself. Okay? I'm not going to make the market work around Nadex spreads. It doesn't work that way, does it? The market doesn't work around you. Market doesn't work around the instrument you're trading. The market doesn't work around the company you're trading with and their derivative products. You have to work around the market. You have to see a setup happening and figure out what is the best way for me to trade this trade. Is a spread better or is a binary better? What gives me the biggest advantage? What gives me the best risk management, risk to reward? What are my premiums looking like? Right? Is there a good close spread that I can put up a decent amount for and have a decent... Yeah, great. Well, maybe I'll take that spread. Oh, no, there's not any spreads. They're all at like 50 and 60 premium. Well, switch over and look at binaries. Is there a good binary available? Is there a good in-the-money binary available? For those of you that were on yesterday's binary webinar, I showed you a whole new way to look at trading binaries with the power play trades, right? When you're in a situation where these are priced really high, that means that IV is priced really high, which means it affects binaries as well, which means you might be able to get a pretty darn good strike for about 70, 75 bucks in that premium area like we talked about. Okay? So check your options. Near the money. Worst case in the teens. Check the intradays. Then look at binaries. That's kind of a step-by-step process there of, hey, how you can potentially not miss the trade. Okay? Why do you think that on those high IV days that these proximities and premiums go up? Because it's high volatility. There's an expected large move. Does that make sense? And the market makers are having to cover themselves, especially when they've got capped risk products close to a floor or ceiling. Okay? So keep in mind, when you see those numbers are high, there could be a big expected move. That makes sense, right? So there's some proximity in there. What happens to binaries at that same time? When there's a big expected move, the price of the binaries gets pushed towards the middle. What do I mean by that? Well, hear me out here. We teach with binaries what? Buy around 30, exit at 60. See that? That's just a difference of 2 strikes right there, isn't it? I could buy this, the market would just have to move 2 strikes worth, 8 points for me to be in at 30 and get out at 60, right? Have you guys ever seen binaries though, where, look at the weeklies for example. If I bought at 30, I have to go 1, 2, 3, 4, 5, way down here to get to 60. Oh man, much bigger move. Yeah, 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 Kevin, yes. Does that make sense? Have you guys ever seen that where, sometimes you can be looking at binaries and it's just a little bit of a move to double your money, but sometimes, man, they've got them priced really close, where just one strike to the next is just a few dollars away, it seems like. Have you guys ever seen that on binaries? Right? Where it's like, man, between each strike is just a few dollars. Yeah, that's the same thing. When IV is high and there's an expected big move of the market, do you think they want, do you think they're able to price big price gaps between strikes when they're expecting it to move big? Can they really price in big gaps there for you? No, they can't do it, can they? So when there's those big expected moves, the prices all get closer together, like in that weekly example, and the prices get pushed more towards 50, meaning towards the middle. Does that make sense? Where there's not big gaps between them. They're all kind of pushed towards the middle here. And so you think to yourself, oh man, these market makers, they're trying to screw me. Well, they're not screwing you. That's just the way options work, right? But let me ask you something. If all of these prices are pushed more towards the middle, how many of you were on yesterday's webinar with the binary webinar? Yeah? Any of you that weren't need to watch it, because we talked about premium collection with binaries with the power plays. And this will make a ton of sense to you. If you're looking to trade a spread and the premiums are too high, what does that mean? IV is high, right? So when you look at binaries, what is that going to mean for binaries? That all the prices are pushed towards the middle. Are they pushed up towards 5? Are they pushed up close to 90 and 100? No, they're pushed towards the middle with little gaps between them. So that means a binary that's quite a bit in the money, that might normally be priced around 90, might then be pushed closer to being priced at what? 70. Does that make sense? Did you follow me there? So that means you could possibly get an even higher, further away binary for that 70-75 we talked about yesterday. Right? What's the other thing that it means? It means that binaries are going to move slower in value going through these strikes, correct? So our out of the money binaries that we might buy at 30 and try to get out at 60 are going to take a much bigger move than they normally would compared to 30, 60. So do you see where when you see the IV is high and the proximity of spreads is high, and there's not a good spread for you, and you want to flip over and look at binaries, do you see that that might be a really good time to utilize the strategy I taught you yesterday for premium collection, and how you could even get an even better potential strike on premium collection? Did I lose anybody there? If you weren't on yesterday's webinar, I might have lost you. But if you watched yesterday's webinar, this will make a lot more sense. Okay, Mike, you say a little. So, Mike, you understand that, we all know there's times when proximities are real high because IV is high, and we can't get a good spread, right? Well, and the reason the proximity is high is because there's an expected big move in the market, so they're pricing it in, right? Okay. If there's an expected big move in the market, Do you think they're going to leave binaries priced like this, where I could buy it at 20 and just a nice little move would get me to 84? They're not going to do that, right, Mike? They're going to put it, you've seen it, right, Mike? Where it's like this one's like 22 and then 25 and then 27 and then 50 and 49. Like they're real tight together because all the prices kind of get pushed towards the middle, as it were. They're pushed towards 50. They don't want the prices getting down close to zero or down close to 100 quickly, because you could buy in at 30 bucks, and the market makes a nice little move, and boom, you're up at 100, and they got to, or 90, they got to pay you out, right? This is how options work. It's not about Nadex, but how options work. So what does that mean, though, when these strikes down here that are right now priced in the 90s get all pushed towards the middle, and they might be priced at 70? That means you're getting a really good, far away, in the money strike that you normally pay 90 for, and you might be able to get it for 70. And if you take that into account of the premium collection strategy I taught yesterday with the power plays, you might just have a huge, big room there. Does that make sense now, Mike? Okay, for any of you that don't follow, watch yesterday's webinar, watch this again. It'll be a huge light bulb like, oh, wow, got it now. So you're not stuck when you cannot find good proximity. You're not stuck with no trade. Okay, look for the close, look for the teens, worst case, then check these, hop over to binaries and look. Okay, I mean, just as an example, like to put it into perspective, and this isn't an accurate example because we're using different expirations, but it would be similar to this. Where's the market right now? 59.49, right? Okay. What strike can I get right here for about, well, there's none for like right at 70. For 80 bucks here, I'm at 59.44, right? So about 5 points away for some, premium collection. If I go further out, which would be, type of example, we're at 59.49. What can I get for like 59.12? See the difference there? Like, that's the same concept of you're going to get further away for about the same price when that premium is high, like when the premium, the proximity is high. So you've got options. Make sense? Does that help at all? Of, okay, what do I do when that proximity is so high I can't trade? Look for the first option, look for the teen option, look in here, then look at binaries. You've got options. Okay? Randall says, do you feel like dailies are the best all around? You're talking about spreads, right, Randall? You're asking about spreads, not. If I'm trying to mimic the market, meaning if I've got a power play set up and I'm hoping it shoots down 20, 30, 40 points, and I want to make the most of that, and I want to trade it as much as possible like, a futures trader, then absolutely 100% without a doubt. The dailies are the best because the dailies are going to move closest to 1-to-1. For one, they're wider than these here. See, like these here, these are like 100 pip spreads. See that? All these numbers add up to 100. Okay? So even right here, that's not bad, 4, and I'm getting in, I got about 43, right? Spreads work the same as binaries in this one sense. Okay, let's look at something here, just to make sure that this makes sense. Okay, so if I buy this binary right here for $15, okay? And it's at 59.60. Where is this other strike? 56. It's 4 points away. So I know that if I buy this and the market goes up 4 points, I could sell it for how much? 21, right? I can see that on the ladder, right? I can go down or up, right, to see. So right here, look at something. 15 to 22. Then what? 28 to 42. Wait a minute. That's a pretty big difference, isn't it, Randall? Just one strike away. Wait a minute. Here I go 14 to 24. Here I go 30 to 45. Here I go 50 to 66. Nice. But what about here? 90 to what? 92. 98 to 94. Now I'm going backwards. So in this, if we just drew a square right here, in this area, I don't move a whole lot towards the top of that binary, do I? Like I can be in that binary trade and the market's moving and moving, but my value is not going to move much, is it? As it gets closer to the top. What about up here? $3 to 25 cents, $5 to 150, $7 to $10. Well, that moves awfully slow at the bottom or top there too, doesn't it? Where does the binary move the fastest from? In the middle here, right? In the middle. Also, why do you think I didn't teach you to buy $5 binaries in Power Play? We taught to buy where? Like around the 30s, right? That's going to get you the quickest move. So that makes sense? It's the same exact thing with spreads, okay? If you have a spread, okay, and this is very key to understand. That's really a good question, Randall. Thank you. Okay, if I have a spread, and let's just say these numbers aren't going to match, but let's just say, for example's sake, that it's a 100 pip spread. Okay, let's say it's a 100 pip spread. That spread is going to move slow this bottom, you know, say 20%, and that top 20%, as it were, right? Where's the spread going to move the fastest dollar for dollar for me? In towards the middle. Does that make sense? So if I want to buy in, for one, I want to buy in as close to where the market is. Okay, don't pay attention to where the price really is. Okay, I want to buy in as close to where the price is with a low proximity. Correct? But if I'm buying in right here, even though I might be able to buy in right close to where the market is, am I going to get dollar for tick this last little bit? Am I going to move much that last little bit? No, it's going to be slow going. Everybody understand that? Now, so if I'm looking at a shorter term spread that's a smaller floor and ceiling, I don't have as much room in here before I hit that slow point. You follow me, Randall? So when we look back right here, on this spread right here, for example, where am I at? Well, I'm buying in at 54, which is about the middle of the spread. So that's not bad. But here I've only got 47 potential profit, which is fine. Like, that's not bad at all. But what about here? I can buy in, you know, I've only got 21 more to go. That's not going to move very much because this is a 100 pip spread. If I'm buying in at 79, basically, that last 20 is not going to move very fast, is it? This last 33 is not going to move very fast, is it? You know, I'm going to be looking at one of these two spreads. You know, if I had to go with like this 4 o'clock one, I'd probably do that one because it's real close, and I've still got 48, almost 50. So like those next 25, 30 might move pretty quick before it slows down on me. I like this the best, getting in at around 35, right? Because that's putting me in right at this level. So I know I've got the fastest move. But it's 15 away, and this is only 2. So I'd probably go with that one. That would be my second choice. Does that make sense? So the dailies are wider, so you've got a lot further room till you get to those slow points. And you've got a lot more of them to find one that's right in the middle, or maybe even a little on the lower middle side. Does that help at all, Randall? Okay. Yeah, Eugene, I mean, they're really, spreads can be confusing to learn at first. But when you learn to trade them, they're super easy, okay? If you use the scanner, all right? So what I would recommend that you do is while you're learning spreads and while you're demo trading spreads, stick to those rules, okay? Of lowest proximity, then let me look a little further out on the dailies, then I check these, and when I check these intraday, what am I looking for? Not just the proximity, but do I still have some room to go? Then I'll look at binaries. Kind of a 1, 2, 3 process. All right? So, all right. I'm going to, I don't know if I confused anybody. A couple of you said, okay, that makes a few things clear. So I hope that makes things clear. Okay? Now I'm going to confuse the heck out of you. Max risk may still be of concern to some. Just remind them this stuff. Yeah. Like, don't get caught up in, oh, my max loss is 31, 95, 116. These are not binaries. You don't lose that all or nothing based on one tick. You can go in and do this spread right here and put up $540 in risk. If the market goes back up to one tick above the high of the bar where your stop is, you get out. And where did you get out? About 20 ticks down. You're down 20 bucks. Doesn't matter. Okay? Like, none of that matters. That's just the amount that's put on hold to get in that spread. You're going to exit that spread when it hits your stop of about 20 ticks. It's 20 bucks. Okay? If you're not clear on that, or if any of you are still like, ooh, I just don't like putting up that much money for a trade. What if I lose? Go back here and watch this right here. Understanding risk and reward with Nadex Spreads. Okay? So, I don't want to open a can of worms here. But I want to open your mind to something. Okay? Yeah, I'm going to. Let me just think here. Okay, I want to buy. Right? I want to buy. And man, all of these proximities are so high. Right? They're really high. And these premiums are really high. Trying to think about the best way to teach you this. Okay. Let's just say that we did not have 2 hours and 2 minutes left till expiration on this one. Let's say we had a shorter amount of time. What do we not like about this spread right here? That it's plus 50 to buy it, right? Okay. Where is the market right now? 59.54, right? 59.54. Where can I buy it? 59.67. Okay? So I can buy that at 59.67. Way up here. We don't like that, do we? I hate these high premium proximity things. I hate it. Okay. The market's been going up and up and up and up. Potentially means at some point it could come down. Correct? So, with our power plays, we get a pretty good indication of when that might set up to happen, right? Levels, clusters. So think about this. I can buy it for 59.67.7. It's priced way up there. What can I sell that spread for? 59.67.4. 3 measly ticks away, right? Like it's pretty much almost the same place, right? Because it's real low bid-ask spreads, correct? Like they're right there at the same place, basically. Right? So if the market starts to turn around and give us an indication to go short, this whole time I'm sitting here complaining that the proximities are so high above the market on the buy side. What do I have to realize is happening on the sell side? If I had right here now a setup to go short suddenly, like I've been looking at longs all day long, I don't like the proximity way up here. But all of a sudden, I get a signal that we may be going short. And I don't have, and I've got less than an hour to expiration, say, of the spread. Notice something here. This one that I can buy that's 54 away, where I'm buying it, there's negative $27 a premium in that spread, right? But what if all of a sudden, as the market's going up and up and up and up, my power play shows me we're about to go short? Well, I can look at all these other spreads here, right? And say, okay, this is a close proximity, right? It's a close proximity. I want to go short. But notice this spread that has this big proximity on it. What does it have on the opposite side? Positive premium. Plus $23 premium. Well, what's that all about? Because where can I sell the spread at right now? 59.67.3. I can sell the spread right here. Oh, wait a minute. Now, what's the most I can make on that spread? Well, the premium on that particular one. Okay, it might be a bad example, but so I can sell above where the market is when I'm expecting the market to go down. Yeah. Does that sound a little bit like premium collection we covered yesterday? So if I sell right here and I've got $22 of premium, at expiration, what do I get on my spread? I get the difference of where I sold it to where it expires, as long as it's in the floor and ceiling, okay? But I've only got 26 left to the ceiling. So the most I can make is $26 at expiration, okay? You follow me? So at expiration, so right now I've got $26 of premium in this spread. Say the market just sits here and doesn't do anything and it just expires right here. How much do I make at expiration? $26. The market shoots down 50 ticks. How much do I make at expiration? Well, in this example, the same, because it's at my floor and ceiling. I'm wrong. The market comes, instead of going down, the market comes up 26 ticks and expires right there where I sold it at. How much do I make or lose? 0. Right? Because it expired at the same place I sold it. I'm break even, correct? What if I'm wrong? What if the market comes up 10 ticks and expires right here? Well, then I end up making $16, right? Because I had 26 in premium, say, right? Comes against me 10 and expires, I've got 16. So I stand to make maximum 26 bucks here, right? I'm wrong, the market comes all the way up and hits me and expires right there. I'm break even. I'm even more wrong and it goes up another 26 ticks against me. How much did I lose? 26 bucks. What was the most I stood to make? 26 bucks. Right? 1-to-1 risk-reward ratio, perhaps. But with how much room? What's 26 this way plus 26 that way? A 52 tick range. Oh, any light bulbs right there? Oh, wait a minute. Ding, ding, ding. Whole new world of spreads here that you didn't even know about or think about, did you? Right. You follow me? Okay. Gotcha. All right. Now, I don't want to go on and on and on this. We'll do some more on this if you'd like. Okay? And if you want to see some other examples of this type of trading, check out the Iron Condor webinar. If you go to right here, Elite Education, Spreads, Other Spread Courses, Iron Condor. See that? That will teach you a lot about how to use premium on spreads. Same kind of way you use it on binaries. Because in that situation, what are we looking to do here? We're just looking for time to work in our favor and get to expiration, right? So what you have to keep in mind is when you see, don't look at the glass half empty. Look at the glass half full. Don't look at it from the negative side. When you're all ticked off going, I see all these huge proximities over here on the buy side. The prices are way above the market on the buy side. Well, that also means what? There's potential premium on the sell side if you get a sell. Yeah, Dan, yeah. And also look at this one, Dan. What does this one below it have? $26 of premium in it. But it's not right at the ceiling either. Not only am I getting in with $25 of premium, or now 15, but there's still an extra 100 or 197. Like, there's more room. Does that make sense? Yeah, look at this. Look right now on the buy side. Look at these premiums. What is this $56 premium? $54 premium. What's that all about? Where's the market? 59.58. Where can I buy it? 59.52. So I can buy at 59.52 right here. I can buy into the spread right there. And what do I get at expiration? The difference of where I bought compared to where it expires. Or the difference of where I bought compared to where I can get out. Like, what is on the sell side? What can I get for it? So if I buy something way down here with that kind of premium and the market starts moving up, am I going to get dollar for dollar move as the market's moving? No. But I might get 0.6 or 7. I might make 60, 70 cents per tick. Plus, I got some premium built in there that as the closer I get to expiration, that premium is going to catch up. Just like the closer expiration, a binary gets closer to what? 0 or 100. So always keep in mind when you see things are high on one side, that's when you also want to say, okay, well, that means on the buy side it's real high because the market's going up, up, up. But if I get a short signal, I might be able to, for one, I still want to first of all look for low proximity and take those. Like your low proximity are still going to be your best ones to mirror the market. But worst case, could I look at some premium ones? Worst case, I don't have a lot of time on these hourlies, shorter term expirations. Is there a premium that could be collected on the sell side or the buy side with only 33 minutes to go? Maybe. Is there premium that might be collected on the buy side? Yes. Or the sell side? Okay. So guys, I've heard so many of you just be like, oh man, there's no proximity. I can't trade this. Spreads suck. Okay. There's a lot more to think about. Make sense? Right. To collect the premium and to see what premium's in there, yeah, you got to look at the plus numbers. Okay? On both sides. All right? Because on the buy side, when you're buying way far away, well, then you've got negative premium in there, right? And also it has to do with, are you buying inside or outside the floor or ceiling, and anyway. So I hope the first part of this webinar really helped you to see kind of this process of what you want to do. Look for the close proximity, then look a little further, check these, check binaries. Gives you some more options of, okay, here's what I do. The last part of that probably blew you away a little bit, got you excited a little bit, or confused the heck out of you. All right, we'll get a little more into that. Okay. John says you have to hold to expiration. You don't have to hold to expiration, Johnny, but the closer you get, but you need some time till expiration or a really big move, you need to get closer to it for that premium to start hitting your profit. Okay. Just like with binaries. You know what I mean? Like with binaries, like when you're in that, getting those in the money binaries kind of thing that have some premium in, like you've got to get closer to expiration. You're letting time work in your favor, as it were. So, guys, here's what I want you to do. I want you to kind of open your mind up to some of these other options of binaries. I want you to make sure you go through some of these webinars I have on here about understanding risk and reward. Okay? And for those of you that really want to know more about premium, Go right here, Elite Education, Nadex Spreads, Other Spread Courses, Iron Condor. Complete different strategy than what I just taught you here, but it'll teach you and you'll understand the premium aspect of spreads. Okay? And here's what I recommend you doing. While you're learning spreads, while you're demo testing spreads, you get a power play set up. What you got to do is, there's only so much I can teach you with spreads. You got to get a feel of them. And you got to really understand how they work, with the near the markets or the, or the out of the spreads or the how much time to expiration or the premium. Like, I can teach you so much, some of the basics, but you really got to get a feel for them. And you'll start to understand which ones you like better, which ones work better in different setups. Hey, I've got this particular setup, I've got this expected move, I've got this amount of time to expiration. This particular spread will be my best bet. Like, you've got to learn some of that. Okay? The best thing to do is when you get a power play set up, if you're still in demo and you're demo testing spreads, do 3 of them in demo. Do the near the market spread like you're supposed to be doing, or if you're live trading and you live trade spreads and you get a near the market, okay, and you want to trade live, also demo trade one of these short-term expirations. Demo trade a premium potential trade, okay. Well, on the premium trades, you want shorter time to expiration, hopefully. Demo all 3, or if you're trading one live, pop a couple demos on and just watch them. Look at the different outcomes you get on these different trades. Start to learn to watch how the outcomes happen or how the value of the spreads move, okay, in comparison. Like if you get a near the market spread like you're supposed to real close, you're like, you know what, I'm going to also demo trade one that's like 19 away because I want to see how that moves dollar for dollar. Start learning them and just watching them in demo and compare those different ones, okay? And start to get a feel for them. We'll do some more webinars on spreads and dig even deeper. Cool? Hope this was a worthwhile webinar. Sometimes on these webinar, guys, I don't always know what level each of you are at. So I try to cover certain basics that are needed to set a foundation, then try to walk you through some, hey, 1, 2, 3s, and then teach you a little something new. All right, and like I said, we just keep building and building and building. Cool? All right, guys, I will get this webinar recording up here this afternoon. I've got another webinar I'm running in about an hour here on, I believe I don't even know. I'm doing so many webinars these days, I don't remember what I got. Yeah, Order Prints, Advanced Training 1, okay? And we're going to talk today about mini magnets. And so that webinar will be in about an hour, and then I'll get both of these popped up on the recording. Okay? All right, guys. Thanks so much for your time and interaction. We will see you in about an hour here. All right. Bye. Chuck says my head hurts, but it's all super. Well, Chuck, watch this webinar right here. Watch the one we're on again, and watch that Iron Condor webinar. Your head won't hurt near as bad. And you'll have big time light bulbs and just a whole new direction and vision of ways that you can trade spreads. All right, guys, take it easy. We'll see you in about an hour. Bye.